We have Unmesh Sharma who's the head of Institutional Equities at HDFC Securities. Good afternoon and welcome to the show. Let's first have your take on how you're viewing markets, how you're viewing valuations overall in this setup, and what sectors are looking attractive to you at this point in time.
Hey, thanks. On the markets, there is a lot of cross current going on right now. On the macro, from the US, we believe that higher for longer is the base case, but we still don't believe there's a deep recession. At the same point in time, the geopolitical concerns which have happened because of the most recent war in Israel, we believe is a localized event. Now, in that context, if you look at India, while yes, it is more expensive than the rest of the emerging markets, we believe that we do not see a sharp fall coming in that. Then there are two reasons for that. One is because we believe as we are getting into the second half of this year and as numbers start to get rolled over into FY26, what we will notice is that the earning expectations on Nifty are actually not that aggressive. So the numbers which currently look like the market is trading at 19 times will start to look at like closer to 17. And I believe that in the context of the fact that geopolitically as well as in terms of valuations and balance sheets, India stands out. We expect India to continue to remain well supported. Within this specifically, we believe that the small and mid caps have a little bit more room to run, because one big myth in the market is that they are much more expensive. If you adjust for what's happening in the financials, specifically the banks as well as the cap goods, we believe that the valuations on the rest of the sectors continue to remain quite interesting. And hence, the local flows which are coming through in India will continue to support the market, and we believe that mid caps and small caps should continue to do well.
Right. So a couple of points you've covered there. Bullish on mid cap, small cap. But what about IT? Because at the moment, that one is in real focus. It's probably the only sector with a meaningful decline in trade today, and it's leading the losses on the Nifty as well. You're seeing out of the top 5 losers today, 3 are IT, and of course, correctly so, we are seeing some bit of top line drag with regard to IT. So how do you view IT, and within IT, whether are there any specific bets that you would see would play out well over the medium to long term?
Okay, so in IT, the earnings have kicked off with the IT sector. We believe there are two things here. One is that after at least some bit of correction, numbers are looking a bit interesting. However, that is not to say that everything is hunky dory. Okay, so we have to keep 3 things in mind. One is we have an anti-consensus view that there is a big concern on the US slowdown. We believe that slowdown, but at the same time, deal wins are quite good. So if you put that into context and you look at the example of what happened in the UK, where there has been a lot of uncertainty in the last 3 years, you would notice that actually one of the big shining lights, in fact, geographically has been the UK market. So what happens is that the Indian IT sector has moved up the curve, so as to speak, and hence numbers should start to fall into place, which means 2 things. One is that while in FY24, we'll get 4% growth, that should rebound to 8%. Now, even that is single digit, but at the same point in time, numbers should go up. And the second and most important is that with the drop in attrition levels as well as cost optimization, you will start to see margins actually hold up much better than what people are saying. So in that context, the tailwind on the entire sector is actually quite good. Having said that, what we would do is that if you look at our model portfolio, we have a lot of as in bottom-up stocks in there. Our top amongst the large caps, LTI Mindtree, and then in the mid caps, Persistent, Birlasoft, and in the ER&D space, Cyient is the one that we are looking at. So we are very, very selective, of course, but at the same point in time, we believe that the headwinds in the sector are a bit overstated. So after a little bit of correction, maybe this is the time to actually look at this space.
Right, that makes a lot of sense. What about, and I'd like to emphasize on the large cap because you already seem quite positive on the mid and the small. So with regard to the large, especially in the financial space, We've seen the likes of an HDFC Bank, a Kotak Bank not really move the needle at all over the last couple of years, pretty much zero or maybe even negative returns overall. How should one look at valuations in that pocket, given that mid and small as well as PSU has run up considerably, right?
Mm. Yeah, so look, on the large banks, while specifically I cannot comment on HDFC Bank because of compliance reasons, but at the same point in time, we believe what's happened here is that if you see the nature of the flow in the market, it's been, of course, I'm not talking about short pockets, but if you look at an elongated period of time, you will see that there has been generally outflow from the FPIs and inflows amongst the domestic investors, both retail as well as through the mutual fund route. Now, this generally, if you look at the historical pattern, you will notice that because of high requirements for liquidity, the large banks and consumer names tend to be overheld by the FPIs, and hence there is a technical matter of the fact that the outflows in the FPIs is something which has affected the banks. And the second is that there has been this whole concern about NIM compression. Now, you put that into context. If you look at the PE, okay, now I know that banks are looked at on a price to book, but actually, if you look at it in the context of the index is trading at 19-20 times, while the PE of the banks, actually financials, is around 14-15. So, and you can also see that there is, in greater uncertainty, India with its strong macro fundamentals seems to be a place where people also want to continue to stay invested. So we believe that the pace of selling of the FPI is coming off and on terms of the revival in earnings. There have been some technical matters on the large banks like mergers and change in management and all of that. I think we should start to see a revival in the large cap banks. I wouldn't say maybe this quarter, but at the same point in time, if you're a long-term investor, you should use these valuations to actually start nibbling into this as people start to look at FY26 and beyond.
Right, and what about valuations with regard to mid and small as well as some of the PSU names? Do you still see some amount of juice left, some amount of value left? Because growth is extremely strong, 25% plus in some of the small finance banks, even PSU banks growing at 15% on a larger base, some even growing 20 plus on the deposit front like Bank of Maharashtra. How do you look at those?
Yeah, so amongst the PSUs at this moment in time, if you look at our model portfolio, we have State Bank in there. We believe that with the exception of the top three PSU banks, you usually see that we have a fairly strong quality bias. And if there is a concern in the medium term, it is actually on the asset quality side. While we have not seen any hard evidence of that, we are starting to see some kind of murmurs around that. So while we don't think it happens this quarter or next, but at the same point in time, what we believe is that with valuation so supportive amongst the large caps, there is no reason to go down the quality curve. So in the PSUs, we continue to think that you are well positioned in SBI itself, which is like an equal rate position in our. Amongst the smaller banks or smaller financials, let me put it this way: City Union Bank, Bandhan Bank are top kind of out of index positions in, and we remain quite comfortable with holding these names.
Right. And if I can, coax you further with regard to sectors, what do you feel will be the outlier sector or will surprise on the upside? We're at the cusp of Q2, of course. So with regard to Q2 earnings, what do you think will surprise on the upside with regard to sectors?
No, so the way we are positioned is a little bit more long term than just playing the context, but to a large extent, we believe that the three subsectors which we like a lot. One is we like domestic economy facing sectors. So in that context, if you look at the industrial cap goods, we have a big overweight position there. We have a big overweight position, surprisingly, which is not a sector which shows up in the index, but at the same point in time on the exchanges. We have some, if you see, we have BSE and MCX in there. So kind of market infrastructure, if I may call it that. And the third, we are positive. Hence, if you look at the whole cap goods space, we are also positive on cement, building materials, so as to speak, and on the real estate cycle. So if you put it into context, our big overweight positions really are the domestic economy, hard assets, basically like cap goods, cement, real estate, and subsector within IT. We club it within IT is the market. Is the market infrastructure.
Right. Thank you for that really good context that you've given us, Unmesh, on some of your positions, as well as all your views on IT as well as banks and financials, which are in focus. Thanks so much for your time. But we'll slip into